Well, so this is a really momentous occasion for me. I first started doing these nonprofit seminars. We call them nonprofit roundtables. I think in the late 90s at my former firm, and it was a co-sponsored series where myself and a bank and an accounting firm, we all got together and set out a program twice a year, or a series in the fall and in the spring to kind of match the academic year. And we didn't share mailing lists, but by sending the invite to both mailing lists, to all of our co-sponsors lists, we thought we would have much more reach and get the message out. And then version 2.0, my seminars, when I moved to Farella, we just did them on our own. It's just the firm, and so we built a mailing list. And now, and in all those years, I wanted to do it only face-to-face, even when the technology, I guess this technology's been around for a while. But I really valued the one-on-one conversations and the networking. And as we did the seminars at Farella for the past, I'll have my 7th anniversary on July 1 at Farella. The networking after the formal presentation became really valuable to a lot of people. So one of my greatest hopes for today, as we launch Farella Nonprofit Organizations Roundtables version 3.0, is that people will continue to be able to use this as a networking resource because we can all learn so much from each other. And Matt and I will share with you the things that we know in the hot topics arena, but I often learn just as much from, and I certainly enjoy the participants. So welcome to our 3.0 version for 2020. For those of you who, many of you do know me, for those of you who don't, I've practiced in nonprofit organizations and charitable planning since the 1980s. I'm starting to feel really dated at this point. But I've been in the field for a very long time. I love the work. I love the clients. The one thing that I do also very much value from this group is, please tell us if there are particular topics that you want to hear about in the future. So in addition to giving us feedback on the presentation itself, please do chime in, send me an email, send Matt an email if there are particular nonprofit oriented programs you'd like to see in the future. So with that, I will turn it over to Matt to introduce himself, and then we'll get on with the show.
So my name is Matt Lewis. I have been a commercial finance partner at Farella and been practicing in this area for almost as long as, or maybe about the same amount of time as Cynthia has been practicing. I was very happy to join this program because I just get a kick out of working with Cynthia. She always has some weird and interesting things going on. They're always a challenge. And specifically in this case, because of my work with commercial finance, I got involved very early on in the payment protection program and helping advise our clients to work their way through that. And so that's what I am expected to talk to you about today. The other thing that really thrills me here is, again, being a commercial finance lawyer, I deal a lot with nonprofits, but for most of my clients, they're inadvertent nonprofits. That's not what they intended. So to actually be with deliberate nonprofits is kind of a nice change of pace for me.
All right, so let's get started. The agenda for today, you can see the 5 points here. About that nest egg, that's my teaser. We'll talk about accessing endowment funds in this challenging environment. And then I'll touch a little bit on some provisions in the Corporations Code that give nonprofits some leeway in governance structures under certain circumstances that also has come into play in the last 3 or 4 months. And then I'll talk a little bit about current developments in nonprofit compliance and reporting rules. That's not so much COVID related, it's just current developments, a slightly hot topic, or warm topic, I guess. And then briefly, some legislative developments that you might all have been hearing about and what I'm hearing about. And then I'll turn it over to Matt to get into some as up to date as possible, barring any new releases after 3 o'clock today. So he won't be that up to date. But we should be his remarks will be very interesting to all of you, I'm sure. So with that, Margaret, moving on to about that nest egg. So very quickly after the economy started to unravel in March, the question started to come up that the nonprofit executives and board members reached out saying that they want to use their investment assets, which they invariably start this question with, can we use our endowment now? And it comes up kind of in two iterations. Can we borrow from our endowment? Can we spend our endowment? So before I can even answer that question, it's really important to define what you're talking about. Most people use the phrase endowment fund very loosely to mean their investment assets, the assets that the foundation has set aside and is invested in assets other than cash equivalents, and that they had planned to either use the earnings from pre-COVID, pre-economic meltdown. The plan was to save that for a rainy day or to use only the earnings. So for purposes of answering that first question, when a client comes to me with it, the first thing I have to know is it a true endowment fund? Is it subject to donor restrictions? Is it subject to board-imposed restrictions? Or in the most fun case, you don't know. Some clients aren't sure. It's always been an accounting entry that said endowment fund, and no one, sometimes organizations haven't gone back and had to determine whether it's a true endowment or not. So next slide, Margaret. Will to answer the question of whether your particular fund is subject to the rules that limit use of the principal, we look in California to the California version of UPMIFA, which stands for Uniform Prudent Management of Institutional Funds Act. Almost all states have adopted it, but it's not entirely uniform. Some states have different tweaks on the uniform law. For purposes of my remarks, I'm going to talk about the California version, because I'm sure some of you are not in California at the moment, but those are the rules I know off the top of my head. But if someone's in another state and you want to talk about your own state's rules, we can connect later or offline and drill into that. So under UPMIFA, the definition of a fund that can't be accessed, what we will call an endowment fund for these remarks, UPMIFA defines it as an institutional fund, which means the assets are held subject to a donor's written instruction that the assets not be wholly spent within a year. So that's a very specific, and every word in there means what it said. So it could be an institutional fund that's subject to these rules, but after a year, the board could spend it. So if it's that kind of an institutional fund, then perhaps you can access it. It depends on other restrictions. Contrast that with what often are called quasi-endowment or a board-restricted endowment. If in my call with this client, if we find out that what they're calling an endowment fund is just board-restricted, then a current board can release the restrictions on those assets, and you can spend it on whatever you like. So that's threshold question one. What are we really talking about? Is it a donor-restricted endowment or not? And if it's not, and your board agrees by majority of a quorum or whatever your board approval requirements are, then you can access it. A footnote on what it means to have an institutional fund. A restricted endowment could be a fund that was donated by a single donor, and yay if that's the case and that donor is still alive, the organization can go back to the donor and ask the donor to release it. So that's another way to access what might be, at first blush, a restricted permanent endowment. Ask the donor, if the donor releases all or part of it in writing, then it's available for expenditure. But oftentimes, nonprofits have fundraised for an endowment. It used to be fairly popular to send the year-end holiday giving solicitation to the mailing list, and there would be boxes to check off. Do you want this to go to the orphans fund or the environmental fund, or do you want it to go to the endowment? a permanent restriction can be created by having a written campaign like that, where the donors indicate how they want the funds to be held in a permanent fund. Unfortunately, with that kind of a campaign where you've got an aggregation of a whole bunch of $100 contributions, it's not very practical to go back and ask the donors to release their restrictions. So, Margaret, can you move to the next slide? So this one I'm going to go over very quickly. UPMIFA has really two parts other than the definitions. One is there are standards for how a permanent fund is permitted to be invested. And I've listed here the bullet points about what a prudent board looks at in determining the investment portfolio into which a permanent fund would be put. And so these are typically for a true endowment. The board has thought through has a thoughtful investment policy that takes into account all of these criteria, and that's where the assets are parked. Typically a balanced portfolio that seeks the kind of return that the board thinks is prudent. But I'm not going to dwell on that because that's not really on point for how to access those funds or what the restrictions mean. So if you move to the next slide, Margaret, you can see this is the heart of determining whether you can spend permanent endowment. The board is not limited. In the olden days, some of you may remember the concept of principal, that you couldn't invade principal, that there's a historic dollar value below which the organization could never expend the funds. The new UPMIFA, relatively new in the last couple of decades, gives the board greater latitude to consider these factors in determining how much of the permanent endowment can be accessed on a year-to-year basis. A lot of institutions just have a flat, might just think of it as, well, we can only access 5%, and that includes our administration costs, and so this is the amount we spend each year based on a fixed percentage. The boards can actually consider these factors and decide that a number other than 5% is appropriate. They can, or it can be higher or lower, as long as the board demonstrates prudence by considering these other factors. And so a board might say, looking at all these things, that we look at the purpose of the institution and general economic conditions, and if we don't spend the money, either the institution will fail, or if we don't increase spending, the institution may fail, or the purposes would fail, or the general economic conditions are so poor that we need to spend more money. And a prudent board can decide to change the investment spending policy from time to time. So going on to the next slide, there in the California rule adopted one of the alternatives for UPMIFA that says that there is a presumption that a board has been imprudent if it sets an annual spending rate of greater than 7%. Not all states have that presumption, and some actually presume that it is prudent if you spend less than 7. California, it's not, if you spend less than 7, you're not presumed to be prudent, but if you spend more, it's the burden is on the board to show that that's not a bad idea. California law allows using a 3-year rolling average in determining that 7% presumption. And like I said, this is not a safe harbor. So
Cynthia?
Yeah.
Yeah, just a question. When you say there's a presumption, that's not an absolute prohibition, correct?
That's right. It's not an absolute prohibition. And who would challenge you for spending more than 7%? Generally in California, it's only the Attorney General's office that has the authority to come after the board and say, no, your spending rate at 10%, let's just say, in 2020. Going to 10% in 2020 was not prudent. Prove to us why you think it was. And so that's how that would play out. But most boards are pretty risk averse, and so when they see things in a statute that says they're going to have to prove that they were prudent in going over a spending ratio, they're going to think long and hard before spending more than 7% from a restricted endowment. So with all that said, in some bullets here on practical applications of a spending policy for a true endowment. is to create that spending policy or revisit it in light of the purpose of the institution, the purpose of the fund, general economic conditions, what you know about donor intent. I advise my clients to reconsider it regularly. It's not something that has to be set in stone. And then you tie back your spending policy to the investment policy. So if someone hasn't already written it in the chat room, I'm sure someone will soon, but can't we just borrow from it? And I think that's on the next slide if I don't have this out of order. Moving on to the next one, Margaret. Thinking about borrowing against investment assets. If you have a true endowment, it's not even logically, not only is it not logically possible to borrow, and I've seen nonprofits actually write out notes where they pledge to pay back the endowment. If it's an endowment fund owned by that institution, there is no such thing as borrowing it. If you use the money that's in the permanent endowment, you have spent it. It doesn't matter that the board intends to pay it back. So the bottom line is, if you've identified a pool of investment assets as subject to a permanent restriction, and when applying the factors we just discussed about prudent spending policy, if you need more than that, you can't borrow it from the endowment, and you can't pledge the assets against that to borrow it. To access the capital. And that question does come up. Well, we can get the bank to lend us some money, but they want us to pledge the endowment. Well, the only way to do that is if you've got your donor's consent to release the funds from that restriction. All of these borrowing strategies work just fine against unrestricted investment assets, but again, they don't work for a true endowment. So conventional debt, that works if you get your donor to release it, or it's unrestricted investment assets. I noted here in my second bullet that in the recent days, you may have seen that the Fed is considering buying back loans from banks that meet these criteria. There's a program for for-profit borrowers, but the new information is that they've agreed to buy back up to $3 billion. No, that's the wrong number. I can't remember what the cap on their program is, but the new program should provide more liquidity. More banks will be willing to lend to nonprofits on these terms. 5-year loans, you can see the size range there that is proposed. It'll be the short-term interest rate plus 3%. It's open to nonprofits that have been in existence for 5 years. And within, in here, you're going to laugh. You're going to say, which endowment? Well, I don't know. And the Fed wasn't clear on what they meant by endowment. So I don't know if that means investment assets or true endowment, but probably they're referring to just investment assets in general. In a wide range of sizes, from 50 to 15,000 employees. You may all have seen recent news about some of the biggest foundations in the country floating bond offerings as a source of liquidity for their investment assets. Presumably, they're pledging unrestricted endowment to these bonds. And that makes a lot of sense for a really large foundation that has an investment policy that would really be disrupted if they tried to liquidate the positions in that portfolio to try to spend more now. So it's a great idea. Only makes sense if you have a very large offering, because the transaction costs for a bond offering can be pretty significant. And then there's some other innovative ideas I've heard from some other money managers about pooling investment assets for to obtain better debt terms. So, a lot of creativity right now in trying to figure out how to access the assets invested by foundations.
Cynthia, I have another question.
Sure.
And that is the Fed program that you've referred to. That doesn't solve the problem from the nonprofit's point of view, correct?
Right. I mean, the point of that is that when the Fed buys the loans from the banks, then the banks have more capital to relend to other people. So it's an increasing liquidity in the sector. I think that's everything I have to say about the nest egg. Governance in an emergency. So many nonprofits have very specific rules about who can serve on the board. Sometimes there's designators, sometimes there are directors that have to be appointed by a particular class. Sometimes there are quorum requirements that require that a particular appointee or a particular class director is at the meeting considering the action. So this Corporations Code 5151 came in some time ago, I don't know, within the past 10 years. And I think the legislators were focused on natural catastrophes, but it actually has come in somewhat useful in the past 3 months. So basically what the Corporations Code does, it says during the emergency, when a quorum can't be readily convened to take actions that might be needed, special rules apply. You can see there on the longer side of the slide the kinds of emergencies that are described, and I don't think it specifically calls out pandemics, but because it does say state of emergency proclaimed, and we all absolutely have a state of emergency, these rules do apply. So if you go to the next slide, Margaret, you can see what those emergency rules allow. And basically under this Corp Code section, the board can modify the lines of succession if a director is incapacitated. What if you have a director that, just for whatever reason, a designator can't replace that director, or whatever happens. The board can make changes during the emergency. Moving the principal office has also become a somewhat necessary action for some organizations. If their office is closed, it allows the board to give notice to board members in any practicable manner. So if your bylaws required a specific notice method that doesn't work, you can go around that with these rules. And then you can deem officers to be directors as necessary to get a quorum to take an action. So these are limited usefulness. It's only the board can't just do whatever it wants. It still has to be able to justify that the actions taken are in the ordinary course of the corporation's business. And there's a nice protection in the statute that actions taken in good faith by the people who are acting as directors will not be, the director or officer won't be subject to personal liability for that. So these rules apply. Since they were adopted, I've started adding them to bylaws when we have an occasion to amend bylaws, but they apply even if your bylaws haven't been amended. However, it's useful to have them in there. So if you're in the circumstance where you need to rely on them, you can look at your bylaws without necessarily having to check in with counsel. So that's the nice, I think a fairly useful provision of the Corporations Code that we're actually using. So shifting gears a little bit to some current developments that you all might find interesting. For those of you practitioners in the field, you may or may not have had occasion to have to file a IRS exemption application. That's what a Form 1023 is in the past few months, but just coincidentally, the timing could not have been worse. In mid-March, the IRS stopped accepting paper filed Form 1023s, and they can only be filed using the online application. And it's entirely electronic. It's a web-based fill-in form. It's very difficult to work with. For those of us who are used to filling forms from commercial businesses where everything generally works pretty smoothly and it's very business-friendly, the IRS form is a government form, so it's glitchy. For example, special characters can't be used in the fill-in boxes. So you can't use things like an ampersand, or I don't even think you can use quotes. I think it's just letters and numbers. There's special rules for how you get an electronic signature. And the form, by the way, is quite different from the original 1023 that we've been used to for some years. So, so my words of wisdom, having been through a couple of those since March, is to allow plenty of time to get familiar with the application form and the mechanics of uploading an application. There's been some chatter among the practitioners that have used it, so there's a little bit of learning out there already, but not a whole lot in writing to kind of walk you through it until you do it the first few times. From the folks thinking about fundraising, there have been a couple of changes in the law recently that have enhanced the charitable contribution deduction. As many of you may recall, a few years ago, with the change to the itemized deduction rules, most filers of most individual taxpayers do not use the itemized deduction. I think it's down to as low as 10% now that even get any benefit from the itemized deductions. And so that had an effect on contributions from non-itemizers. So earlier this year in one of the emergency acts, I don't remember which one, they added a $300 charitable contribution limit for non-itemizers. It says non-filers. I should have said non-itemizers. And there was some discussion of increasing that in a later relief bill. So that's a very hot topic, whether $300 is the right amount there. So watch for that. It may go up even as soon as legislation that would come down in the fall. Another enhanced deduction, for those of you who are familiar with the details of the charitable contribution deduction for donors who make very large gifts, typically these are ultra high net worth individuals who want to give away substantially all of their adjusted gross income. So for many years, the cap on cash contributions was 50% of your adjusted gross income. And beyond that, if you gave away more than 50%, you weren't allowed a current year deduction, but you could carry it forward for 5 years. Last year, that was bumped up to 60%. And this year, and for this year only, donors are allowed to deduct 100% of their adjusted gross income to the extent that they've given cash to public charities only. So this special rule doesn't come into play for contributions to private foundations or to donor advised funds. And it also doesn't apply to contributions of appreciated property. You can, and I don't want to get too technical here, so if anybody wants to dive into the details, you can combine your cash contributions to public charities with gifts of appreciated property or gifts to private foundation and still eliminate all of your adjusted gross income with contributions of cash to public charities. So it's kind of a balancing act. And then if you end up giving away more, that carries forward. The same 5-year carry forward rules still apply. A couple of other minor things. If there's anybody on this call that finds it useful to know that tax-exempt bond hearings can now be done by teleconference, that's pretty cool. But that's noteworthy if you're floating in exempt bond financing, because that final hearing is usually the last step to getting your bonds issued. Note to any nonprofits that got stuck with the unpleasant consequences of the parking tax that was imposed on nonprofits for the last couple of years. That's been repealed, and nonprofits can apply for a refund of the amount of parking tax that they had paid. And then finally, there are some new proposed regs that have come out for those organizations that are subject to the unrelated business income tax. There are new rules for what expenses you can apply against your taxable income. So that's also a very technical new development, but one that is worth noting. I think that's all of the current things that have happened some of you may be wondering what is going to happen next. I don't have a really good crystal ball, but I do know that there is a lot of discussion right now among people, nonprofits, and a lot of high net worth individuals that are saying that now is the time for nest eggs to be spent by the charities that have amassed assets, and that's principally concerning private foundations and donor advised funds that have large amounts of unrestricted investment pools for which they've received, the donors received the charitable contribution deduction, but they are not being deployed as rapidly as some people think it needs to be. So one of the proposals that's discussed and is, I think, actively under consideration at the federal level is whether to increase the minimum distribution requirement for private foundations. You may know that currently the minimum distribution is 5%. Many foundations consider that to be a cap, which is not what the law says. And donor advised funds have no minimum distribution. So there's much discussion about increasing the required amount. And also as part of that legislation, the rules would be clarified to say that salaries paid to and travel expenses incurred by family members of the donors to a private foundation would not count towards that minimum distribution. And similarly, that distributions from private foundations to donor advised funds would not count towards their minimum distribution. So those would be, just this one bullet point alone would, even if the minimum were increased modestly from 5 to say 7 or 10%, even at that low rate, this would be represent a lot of additional funding coming out of private foundations and donor advised funds, but not this year. That's not going to help out the operating charities until 2021 or later. There'd presumably be some, it wouldn't apply to 2020 required distributions. It would only be 2021 at the soonest. Another technical loophole closing that is under consideration is changing the law so that contributions from donor advised funds don't count as public support to the charities that receive them. This next bullet point is not a legislative proposal, but is kind of a best practices and a philanthropy campaign among donor advised fund holders and high net worth individuals, and that is half your DAF campaigns encouraging donors who've set aside money in a donor advised fund for a rainy day. There's a strong sense in many circles that the rainy day is here, and getting money out to operating charities to provide food and resources. If now's not a rainy day, I don't know what. It's hard for many to imagine what would be. So with all of this, a bottom line that I would relay to my clients that have private foundations and have large endowments that are not restricted, increased scrutiny is on the horizon. There's a bill in the California legislature that would increase not so much scrutiny, but it points out that donor advised funds are a separate sort of charitable organization in California. So more scrutiny is coming, greater distributions are probably going to come into play sometime, if not this year, soon after. Let's see, I think that wraps up my portion. Margaret, you want to move to the next slide? Oh, no, I have two more. I have a couple more. The employee retention credit, this is a fancy slide that I borrowed from the IRS just to remind folks that if you haven't already thought about using the refundable tax credit, which is useful to a nonprofit, even if you don't pay UBIT, for up to, the tax credit is 50% up to $10,000 in qualified wages. So this applies to nonprofits as well as other employers. It doesn't apply if you got your PPP loan that Matt will be telling you about. But if you're a nonprofit and are otherwise eligible, then you can run through this flow chart and see if the refundable tax credit is available to you. So if your nonprofit has been fully or partially suspended due to COVID-19, or you've had a significant decline in gross receipts, then this refundable credit is available, and you can see the two versions that apply depending on the number of employees. And then I do have one more slide now, I remember. There are also leave credits, and these are highly technical, and as I tried to do bullet points, I thought I'd just lose you all if I haven't already. But I did put the irs.gov link on the slide so you can see that and find out more rules about the sick leave and family leave credits. So with that, I know
we also have some people at the firm who have been working on that for some of our other clients. So
oh yeah, that's
there are
a good
additional
point.
resources available.
Yeah, so on all of these things, I saw a number of chat boxes come up, but I didn't read them because I'm not that quick. So we'll come back to questions after Matt finishes his remarks. And for anybody who has a question, if we don't get to it then, reach out to me separately by email and we'll find a time to talk. So with that, I'll turn it over to the entertaining portion of the show, if you're not all sound asleep by now, because Matt really will spice it up here with his conversation about the Paycheck Protection Program.
Well, I can't possibly live up to that.
No, you can't do it.
I hope everyone enjoyed kind of the clarity and rigor of Cynthia's presentation, because you're not going to find it here. So let's talk about the Paycheck Protection Program. This has been kind of what's one commentator called Mr. Toad's Wild Ride ever since it was initiated 3 months ago. And the theme of what I'm going to speak to you about is the Paycheck Protection Program. Is it a lifeline, or, Margaret, is it a moving target? Next slide, please.
Good job.
So, as I hope most of you realize, the Paycheck Protection Program was an emergency response to the collapse, both the actual and feared collapse in employment as activity shut down in response to COVID-19 and the various public health measures that were announced in response to that. For those who might not be familiar with the Paycheck Protection Program, and statistically there may be one or two people out there who in the United States who aren't, and they may be on this call. The Paycheck Protection Program is a $600 million program, a loan program that was instituted as part of the CARES Act at the beginning of the shutdown period. And it was intended as essentially a bridge loan to various smaller businesses that were thought to, including nonprofits, businesses were thought to lack liquidity to get through what was expected to be a discrete period of economic shutdown. And it was based on payrolls, average payrolls during specific preceding periods. All that's well and good, but what made the Paycheck Protection Program really attractive and created a lot of attention, of course, was the fact that it had built into it this idea of forgiveness. That is, if you maintained your headcount and you did not reduce salaries or hourly wages by any excess amount, and you use the proceeds of the PPP for proper purposes, that is payroll, mortgage, interest, utilities, rent, you could have the amount of the loan forgiven. That is, it was in effect free money, a grant to businesses in order to support payroll. And even if you couldn't fully get forgiveness, the terms of the loan were quite attractive to many people as well. It's basically 1%, and payments don't have to be made for a certain period of time after disbursement, and there's a length of time that you have to pay the whole thing back. So again, a very attractive program. So attractive, in fact, that its rollout has been quite chaotic. And many of you probably have personal experience with this. The first weekend it was rolled out, It was at that time it was a $360 billion program. It was oversubscribed almost immediately. The program, like many legislative initiatives, required a bunch of administrative rules in order to enact, in this case through the Small Business Administration. Those only came out often after the fact, and there's been considerable change over time through them. In fact, what we right now have is, I'm told that once the last set of changes to the rules that were announced yesterday are published tomorrow, we will be on the 19th interim final rule for the Paycheck Protection Program, which I think it's just a wonderful phrase, almost Orwellian, but it captures kind of the quicksand nature of what we're dealing with. In addition to the rules, of course, there's also been frequent updates and guidance that's been given by the SBA and Treasury. So all that is a reflection of one of the two important parts of two important features of the Paycheck Protection Program that I mentioned before. It's an emergency response. Okay, the idea is pump money into the system quickly, get it out there, and we will figure out what the details are later. And we're still figuring it out today. The other piece of this, of course, is it's a paycheck protection program. So the emphasis has been from the very beginning on encouraging. It's not so much been on propping up the businesses as businesses, small businesses or otherwise. It has been on propping up paychecks of those who rely on those businesses for their employment. And that accounts for some of the other issues that have risen their head over the course of the last few months as we've been dealing with this. So it has been a focus on payroll maintenance for what was initially an 8-week period. That raised all sorts of questions. Margaret? Next slide. Oh, I don't want to indicate that the Paycheck Protection Program has been a failure. In fact, the answer to the question whether it's been a lifeline or a moving target is obviously it's been both. Okay, and one indication of the success of the program has been there's been $500 billion loaned to date. I just want to point out this graphic here. This actually hangs on Cynthia's wall in her office. I want to point out that this is just an example of how practical and results-oriented she is.
Yeah, it's my savings account.
Next slide, please. So there have been any number of issues that have risen from the program that people have had to deal with, and I'm sure people on this call have some experience with that. First of all, I think some of the assumptions that the program was created under turned out not to be so. The most notable one, I would think, would be its duration. Again, this was intended as bridge financing to help people get through a crisis. And so the thought was that, well, if we give enough money to basically cover 8 months of specified expenses, that should be sufficient. Now, here in California, of course, we're already past our 12th week of shelter in place and like, so maybe that was a tad optimistic. It also forced employers into some awkward decisions. And that is, so what if the nature of your business is such that you're a restaurant? We'll take a for-profit business as an example here. You don't see any chance of opening up right now. Are you supposed to just keep people on payroll twiddling their thumbs? Or when and how should you kind of right-size the business for what you expect going forward? If you are a nonprofit that runs a seasonal program, you may have canceled the program for the foreseeable future. Again, what do you do about your employees? How do you manage that situation? So the requirement one of the requirements of the program had been that you spend at least 75% of the proceeds of these loans on payroll. What if you don't have, and it's inappropriate for you to have employees to that extent, particularly on a short 8-week period? So the flexibility just wasn't there. As I mentioned, as legislation, it required an administrative overlay to understand how the program was going to be administered and what the details were. Many of the initial Treasury regulations were found to be quite restrictive, perhaps unnecessarily so. The requirement that a minimum of 75% be spent on payroll, that's from the administrative, that's from the SBA. That wasn't Congress. That was an administrative interpretation. There have been, you've seen some reference to this in the news, businesses that were owned at least 20% by ex-felons or people currently under indictment could not qualify. What that had to do with keeping payrolls, unclear. So was that overly restrictive? That has been cut back recently. One of the biggest ones was a requirement that borrowers certify that their loan was necessary in order to keep their operations. Initially, many people took that very liberally. And in fact, that was deliberate on the part of the SBA and public commentators. They were encouraging people to borrow as much as possible. However, when unfavorable publicity arose, a number of what were perceived to be larger public companies took advantage of the program, Shake Shack, the Lakers, there were a number of others. Some very restrictive interpretations came out, saying that we at the SBA are going to look very, very hard at this certification of necessity. This caused an enormous amount of angst among many borrowers, particularly if they at least had arguably other sources of liquidity that they could use to get through this gap period. And in fact, I will tell you that there were a number of borrowers that I had to advise that they probably should give the money back just because of their specific circumstances. Now, since then, Treasury and the administration have backed off a little bit, but the requirement of necessity is still out there, at least in some modified form. So what is the response to these issues that keep coming up other than issuing additional interim rule after interim final rule? Margaret? There have been three responses in the last couple of weeks I think are important in keeping us, in helping us understand where this program is going and how valuable it is. First of all, there's the Payroll Protection Program Flexibility Act that passed, I believe, on June 5th and was signed into law then. Secondly, there have been many new interim final rules, and there will probably be more interim final rules. Third, we've had some congressional hearings recently, which, while not having the force of law, give some indication as to what we might expect going forward. Margaret? So let's talk about what the combination of the PPP Flexibility Act and the new interim final rules have kind of settled down on or helped to resolve. One of the most important things is that they have extended the covered period. The covered period is the period in which you are required to spend the PPP funds, and that your expenditures during that period are what count towards your loan forgiveness. Originally, it was 8 weeks from a loan disbursement. Now it is 24 weeks, or until December 31, whichever comes first. Ignore the subtitle there, that's actually misplaced. We'll get back to that in a second. Secondly, the minimum payroll expense requirement, remember I mentioned that you had to spend 75% of your PPP loan on payroll in order to be forgiven, has been reduced to 60%. So now you can take your PPP loan, you can use it over a 24-week period, and you only have to spend 60% on payroll. That's enormous flexibility and should resolve a lot of people's qualms about forgiveness. And in addition, the rules in the recently released PPP program forgiveness applications make it clear that even if you don't make the 60% threshold, that's not a cliff. That does result in a proportional reduction in your forgiveness, but it's not an all or nothing situation. Again, a much better situation than we thought we were going to be in. As I mentioned, the entire concept of forgiveness was based on maintaining wages and salaries and maintaining headcount. There had been a safe harbor put in the original CARES Act that if you rehired people to bring your FTE, your full-time equivalent headcount, up to where it was compared to the pre-COVID measuring period, and that's the period either at the beginning of this year or the between February and June of last year, you had the choice of those. Then you could go ahead and have 100% of your otherwise qualifying PPP loan forgiven. If you had failed to maintain that headcount, or if you had excessively reduced salaries of people who did remain, then there was a reduction, a proportional reduction, basically, against your forgiveness. So having that safe harbor extend to the end of the year so that you can go ahead and rehire at the end of the year, and people that you rehire or count against your full-time equivalent headcount is again, a nice safety net. There are additional safe harbors. You have a safe harbor. You don't have to rehire if the person you originally let go is not available and you can't find qualified replacements. Okay, so that's, that may be the case for certain specialized businesses. Second, you don't have to rehire if the reason you're not rehiring is because you can't open your business or run it at a full click because of government imposed health restrictions. That is, restrictions imposed by OSHA, restrictions imposed by the CDC, restrictions imposed by Department of Health and Human Services. Now, it's important to understand that these are direct restrictions as we understand it now. So if you're a restaurant and you can't open because there's a shelter-in-place order, you are excused from meeting the full-time equivalent requirement as a condition of getting full PPP forgiveness. If, on the other hand, you're a supplier to a restaurant and you can be open, even if you don't have customers, because the restaurants can't open, you can't take advantage of the safe harbor. So it can get a little technical. We talked about the term of the loan. Again, it had been pretty nice before. The original concept was you had 6 months from disbursement before you had to pay anything on the loan, and then you had up to 2 years to repay the loan back. For loans made after June 30, which indicates that, by the way, the government is expecting there'll be loans made after June 30, then you will have up to 5 years to repay the loan. You will also have an extended repayment period. Essentially, for most people, the repayment period will begin in October of next year, so it won't interfere with cash flow before then. There is some technical issues about payroll tax deferral. There were some questions about whether payroll tax deferral was allowed, even if you were, in essence, paying your employees through the PPP, and now it's been clarified that deferral is, in fact, allowed. So next slide, please. So the PPP process has tended to be 2 steps forward, 1 step back. So there's additional clarification, and then as that clarification comes along, we find additional issues, and that continues to be the case. The necessity standard that caused so many people such heartburn at the beginning of this process remains in place. You are still are required to, as a part of having taken out the loan, to have certified that the loan was necessary. And for certain borrowers, there will be an audit at the time you apply for forgiveness that will determine if, in fact, the loan was necessary. The standards of that audit are not set. We don't quite know what they are yet. The good news is that if you borrowed less than $2 million, as a legal matter, you really don't have to worry about it. The SBA has said, we're just going to assume borrowers at that level needed this as a matter of liquidity. I mean, if you committed out-and-out fraud, no matter what you borrowed, and I'm assuming that's not relevant for anybody here, there's still a problem. But for most borrowers who have loans of under $2 million, necessity is no longer a problem. There had been some confusion, and this slide was made before some of the guidance came out yesterday. There had been some confusion about when a PPP loan is made for these various timeframes, or these various measurement periods that we talked about for forgiveness and payment. It seems pretty clear right now that it is when the first funds are dispersed to you as the borrower. We've talked about the extended repayment period for loans made by for loans made by June 30. Okay, I had mentioned before that the extended repayment period only applies to loans made on or before June 30. I mean, after June 30th this year. For loans made before, that is, people who already have loans, the 2-year period still applies unless the lender and your borrower agree. Obviously, a lender can sit on its hands here, and they've got a fair amount of leverage in that discussion. So it really is going to be a matter, I think, of public pressure and the lender's own feeling of its relationships with its borrowers that are going to drive whether existing PPP borrowers will be able to take advantage of an extended repayment period. There's been some question about the $100 to $1,000 salary cap. That is, the PPP loan is based on and can be used to pay the salaries of employees up to an annualized $100,000. It is now clear from some of the more recent guidance given that with the extended 24-week period that you have now to the covered period that you have to use your PPP loan, that includes payment of a proportional amount of the first $100,000 of compensation of cash compensation for highly compensated individuals. It's about $46,000 bucks. So that's a pretty nice thing. It is not nearly as clear. In fact, it's becoming clear that it doesn't apply to self-employed individuals, partners, other equity holders in a company. I don't think that's going to apply to many people, if anybody, on this call. Final issue I mention right now is when an existing borrower should elect to use the 8-week covered period. Again, if you were an existing borrower, you could take advantage of the new 24-week period to finish spending out your PPP funds, or you could just say, "No, I'm good with the original 8-week period." For most people, it doesn't make much sense, of course, to use the 8-week period unless you've fully used all the funds. You're quite confident that they qualify for forgiveness, and you just want to get this thing off your books. But again, for most people, that should not be an issue. Next slide, please. So some takeaways. First of all, PPP funds are still available. There's still about $100 million worth of $100 billion. I feel like Austin Powers there, Dr. Evil. There's $100 billion of PPP funds still available through June 30. So act now. Now, again, if you remember some of the things I was telling you about before in the changes, they contemplated an extension of the PPP program, but that extension hasn't taken place. So if you want the funds, you've been hesitant because you were unsure of how the forgiveness program was to work, and you see that now it appears that you will be able to use the funds appropriately and get forgiveness. This is the time to act. Finally, my favorite television show when I was a kid used to end every session with, tune in next week, same bat time, same bat channel. I would do the same for Congress and the administration. Recent congressional hearings have indicated that there is still considerable support for extending the program and liberalizing it in various ways. We don't know what that's going to be, but we can fully expect further rules, guidance, modifications, and more final interims. So that is the PPP program. I want to thank everybody for sitting with us.